Okay, good afternoon, guys. Welcome to another live trading clinic. We're going to focus on the Bank of England this afternoon. So I'll just run through the short presentation, get that out of the way. Then we'll look at the markets, go a bit of the fundamentals. Interesting moves in the markets. You can see here, markets are moving around quite a bit today on the back of the IMF comments and what was said by the Fed. But we'll get onto that in a sec. So the risk warning, remember that spread betting and CFD trading carry high level risk or capital, resulting in losses that exceed your initial deposit. They may be suitable for all investors. Please ensure you fully understand the risk involved. The information and comments provided here under no circumstances will consider an offer or solicitation to invest. Nothing in nature construed investment advice. The information provided is believed to be accurate to the date it is produced. Education only. Content of the webinar is personal opinion of the moderator, no-trade.com. The contents not constitute financial investment or tax advice. Trade.com is not accept the liability of a comments or comments made during this session. So we're going to go over some live charting analysis, as always. Multiple time frame trading. Fundamental analysis, which is very, very key while the market's moving right now, and then why we're obviously going to trade this Bank of England event or non-event, and then live real money trades. Yep, if anything is good, I'll trade it. And Q&A, again, these things will revolve around you guys. So interesting. I'm going to take gold first of all, because we've had quite an interesting technical style move here. Again, these Fibonacci levels are very, very important. So, we'd got this fairly strong rally in gold, but then we closed significantly below this 50%, just here at 121865. Then the market really erased pretty much 2 days of gains in just a couple of hours. And I really thought that was the start. We've got some big levels here down at 1203. I want to get into, the below 200 again. I really feel that once you break this kind of 118 key level here, the market is going to get absolutely destroyed. And gold, as I keep saying, it's going to hit $1,000 by 2015. I don't know if it'll be quite by 2015, but it's going to be closer to $1,000 in 1900. That is certainly for sure. So after the IMF came out and said that global growth is probably not as good as predicted, well, who would have thought that? Again, these people think we're stupid. And then the Fed have, again, been very cautious on interest rates, saying that growth and the job creation isn't quite as good as we thought. So maybe we're going to hold off a little bit longer on rates. I don't know how long they're going to hold off for rates, or to be honest. I mean, I think this whole smoke and mirrors. It seems we're going from one bit of disastrous data to another, then everything's fine, then everything isn't fine. It's all a bit boring, to be honest. And all the speculation we've got today about the Bank of England, which we'll go over in a minute, again, it's all futile. No matter what happens in 2015, be it the beginning, the middle, or end, interest rates are going up. Simple as that. So 6 months less pain, 3 months less pain. Does it really matter? Once they go up, they're not ever coming back down. What I mean ever, probably for the next 10 years. Okay, so once they go up, they're going up, and they're going to continue to go up, and they're going to stay up. Simple. They have to. It's called economic cycles. There's absolutely nothing that can be done about it. So gold, again, when we got the bad news out of, for the growth and the perhaps, the people were jumping into gold because interest rates are likely to stay, a little bit lower for longer. We raised, that 4 hour of selling period in one candle. So very important to know your technical levels, because basically we could have sold the 50% yesterday and made down to these lower levels, 136 ticks, markets then bounce back up, and you make it from the bottom to the top in one candle, 140 ticks. Market then bounces off the 50%, so we know it's a technical move because resistance becomes support. The market then goes to make new highs. So where's gold going to get to? Potentially 1240 spot 70, break the top of hourly Bollinger Band and then come back down into the range. So I'd expect realistically, as news gets discounted pretty quickly, we'll be trading more towards the end of the week down at 1218 again. So markets might make the highs up here. I don't really see enough momentum to push gold any higher than that. Then the markets will get back here. So selling opportunities of gold to get back to the 50%. You've got a few hundred ticks on the way down once we get to 1240 spot 70. So again, a prime example how fundamental news can come into the market and change the actual direction of a trend. So when I talk about trading, I'm always drumming it into you guys that it's the 80-20 rule. So again, look at this key level in the FTSE here, coming down to a buy signal down here, because the market's been oversold. So if we break through here, we won't stay too long. So the FTSE, that's a good buying opportunity right now. We've got 1, 2, 3, 4, 5 hours of selling. Even the market might break through a little bit, but I'd suspect the market at some point over the next 3 hours will find support on this level and get back up. There's only so far, a market can move, in directionally, and I guarantee that's pretty much nearly 50%. from where the up move started. So take where the real up move started here to the high, 50%. Well, through the 50% and hitting the 61.8. So this is a good area of attraction in the FTSE now. So we could have a little bounce off here and the market get up higher. So yes, as I was saying, gold, a very good example how, a trend is formed and then broken by fundamental news. So again, if you want to understand if this is the top and the bottom of the market now, so if we are going to get back, then gold is going to go out to that 50%, which ties in really with that 1218. So looking for a high in the markets at some point, and then this area here for a point of natural correction for the market to get back down to, because the actual trend of gold is still down. Look at the higher, the higher time frames. Every time I speak to you guys on FX Street, I talk about this level here, and when it finally breaks 1183, then gold's finished. It's $1,000. It'll be $1,000 within weeks. Okay, so again, you can see again how the market has been very, very strong, consolidated towards the top, now towards the midpoint, and again, all you have to do is look for that 50%. Time and time again, it comes back into play in the market. 50% is here. So while we stay below this 50% here, around about the 1312 mark, yeah, we're still bearish. Yeah, and okay, we've rejected the break a couple of times, but there's more wicks on the top on the monthly. So, just cycle through the charts, looking much, much more bearish than bullish. Much, much bearish than bullish. On your hours, you're just looking for that, getting your tops, selling back down into the range. Euro dollar. I don't really have to go on any more about the euro dollar. Again, I'm massively negative. I still think in the next probably 2 to 5 years that the euro is going to split into north and south. It isn't working, hasn't been working, never has worked. It's just been a way to spend a lot of money in countries like Portugal, Spain, Greece for them to get their infrastructure, not be able to back it up, and eventually just to implode. So lower high, lower high, lower high, lower high. Surprise, surprise, euro dollar sold off. So again, similar situation to gold. When we hit this hard level down here, round about 125, well, the euro is fairly comfortable and really should be trading, really. Should never been trading up here. When it does break that, then we've got all the room to get back to. So we're way below the 50%, I would say, this up move anyway. But I would say once these lows are hit, the last technical level we've got is 1.16. Which would be a reasonable low for the euro, but I wouldn't be surprised if we're trading more like, what would I say? I reckon we're going to be at 0.7. I think the euro is going to get smashed. So again, you can see that 50% is actually coming up here. So that 50% is a real pivotal point. Actually, we're not a little bit higher than I thought. So when we do break these lows here, the 61.8. at 114 is going to be a key technical break, and then we've got the gap back to the low. So I would say realistically for me, yeah, okay, well maybe not 0.7. Sorry, I'm looking at the euro. Yeah, euro dollar. Sorry, I'm just thinking of another product in a minute. Yeah, okay. So, 114 again would be a nice break point. I don't know if we get to that by the end of the year, but it just depends, doesn't it? If we hit these low points here, how at 120, how aggressively the market's going to sell off. So really, to that point, we've got quite a way to go, really. So maybe that's a little bit ambitious, but I would say once these lows are tested, then we're certainly going to compound this downward movement and see the market really start to test these lows. I mean, it's a clear downtrend. You could put very nice trend channel in here. So the market, again, essentially, once it breaks 114, has got downward movement before it then finds some support. So maybe parity, maybe one. Yeah, maybe we get to one. Yeah. Well, I'd say probably by the time we get to one, in the future tense, that could be around about here. So maybe not until 2016. So yeah, down, up. Yeah, tricky one. Yeah. Not quite as clear as I thought that one, actually. Anyway, euro's going to go down, so sell highs in the euro. So again, once we've hit this low point here and the rebound, maybe it's not time to short the euro just yet. So perhaps look at the weeklies and try and pick a top. I mean, we've been basically selling off for all these weeks here. Okay, so at some point we are going to bounce back and get some profit taking. So maybe round about 128,593 or 13. 13 seems like a good level to possibly bounce back, and maybe potentially as high as 132, and then start selling. There's no point selling now because we're in profit taking and people are just buying back, from short positions. So realistically, what I'm trying to tell you is that yes, I still think the euro is a good place to short, but don't short it at the bottom. Short it higher up the chart. Okay, short it higher up here. So that is the euro dollar and pound against the dollar again. I still think we've got a lot more strength to come. Going back to this monthly chart, the 50% was just above here, so that was a good place for the market to reject and come down. But we haven't really dug down into these lower parts, and interest rates are going to go up in the UK for the US. I'm certain of that. I've been saying that for a long, long time. So I think the uptrend is going to continue. So the uptrend on the monthlies, it's quite a nice one. So maybe we get as low as 156 for the market, then finds support, gets to that 50%, which is up here, and then gets back. And I won't be surprised, early next year when interest rates, have gone up, or certainly, inevitable. We don't really, we're not trading closer to 1.87, 1.9, because we all know that, interest rates have been low for so long. People, will put more money into the UK, will take advantage of them interest rates and, convert their, euros, dollars, Swiss francs or whatever into pound, to get that benefit, because, the Bank of England's never going to go bust. So it's a safe place to put your money. So I would say, yeah, again, very, very much the opposite of the euro dollar. We're looking to sell them highs, looking to buy the bottoms in the pound. So that could be as low as these levels at 157, around here. But long-term trading, that's certainly where the trend is. You just have to look at the weeklies again. Maybe we've hit a hard bottom here, then we start to find support on these levels. The market then breaks these highs. I mean, I know it looks hard to understand, when we talk about these weekly and monthly charts, but an hourly makes up days make up weeks make up months. It's all the same data. So what you're trying to do is pick out an opinion from these higher time frames, take it to your hourly charts, and figure out what's going to happen. So we stay above this 50% line here, then we buy. We stay above this line here, we buy, because the Fibonacci retracement of this one candle is way above the 50%. We only got back to 23.6, showing that all the bulls are still in this market. Yeah, so we get back to 23.6, find support on the high. Yeah, market then goes on to make new highs. So these are your targets up here. Yeah, so it's just having an opinion from the higher time frames, taking through to the lower time frames. So obviously, nice bounce here off that level that I said. So we've got some fundamental data coming out today, the Bank of England. So again, expected to be a non-event. I love non-events because there's an opportunity. People, so-called experts, love to call these non-events because they don't have anything intelligent to say. So when Reuters quote, experts polled, I'm one of them. So I'm just as qualified to say, as much as anybody else out there, what this really means. Well, it really means that everything's priced in. There's no correlate. There's no surprise to me. There's a correlation between the pound spiking and interest rates being announced today. And yes, there won't be a change in the core interest rates, and nothing essentially is going to change. But as nothing is said, all we're doing is building opinion that, okay, nothing's said, so we know interest rates are low and have stayed low. But if nothing's said to contrary that, then we know that interest rates are going up. So all the market is doing is continually speculating when the interest rates will go up. Now, different polls, different people saying it'll be February. Then we've got people saying July. Again, I've maintained for over a year in FX Street, I think, that interest rates will go up the first quarter of 2015. House market is slowing. What does that even mean? I don't even understand why every time I turn on the news we're talking about house prices. We've just created a monster. We've created such a messed up way of perceiving our wealth, our financial security, what we value money. We've got all these stupid pensioners bounding around, thinking that they're, Warren Buffett, because they made some money in property. All you had to do is buy a property and pay the mortgage, and you were guaranteed to make money. But, all these things work in cycles. Okay? At some point, there's going to be a crash, a correction. How big it'll be, I don't know. Nobody knows. But there's 1.2 trillion quid tied up in property. I know that much because they're the facts. But then there's 1.44 trillion of personal debt. Yeah? Something not quite adding up here, is it? Everyone's sitting around going, oh, I'm rich because my house is worth $500,000. It's only worth what someone will pay for it. And so you have to live somewhere. You've seen all the people, 5-10 years ago going off to Spain, getting and buying the cheap property over there. Yep, can't move back to England now, though, can they? Not so clever now, are they? With the euros getting spanked. All these things work in cycles, and if you haven't worked hard and made your money through normal, kind of jobs and business and that kind of stuff, making money in property is not a God-given right. It's not, it's not something that's going to be, applicable forever. All these things move in trends, and the more we kind of rely on this, and the more we, squeeze people out of the markets, and not allow people to get on the property ladder and have some responsibility. The more it's going to destabilize the world and the economy. If you're a kid coming through now university with your 15, 20 grand worth of debt, and then you want to buy your first house and it's 300,000 quid, and you get your job at McDonald's with your first in maths from Cambridge, at 12,000 quid a year, what chance have you got? What you're going to do? You're going to find what? Your 40,000 quid deposit, and you're going to be able to pay, your high mortgage rates when interest rates go up off your McDonald's wage. No, it's just not going to happen, is it? And then we're going to, we know when history says about the gap between the rich and the poor, and, the higher it gets, there will be a point where it breaks. So all these things, are pretty depressing in some respects, but they're all something we need to consider. What you need to make money of. You need to diversify. It's not all about having your money in stocks. It's not about all having your money in property. What I was taught as a very young man at PricewaterhouseCoopers, when I invested for some very, very rich people, was to diversify, because you never fully know. So you have a balance between bonds and stocks. You have a balance between, your T-notes and your shares, your currencies, your portfolio in property. You balance it all out, because, you never know what's going to be the big thing or the biggest loser. So, by having a diversification and a diverse portfolio, you can balance out them longer term risks. So you think property gains, again, have only been 10 years, 15 years. You pay your mortgage over 25 years. So people now that are seeing, buying houses in London and saying, well, my house has gone up £1,000 a month for the last year. Well, that's going to continue doing that for the rest of my 25-year mortgage. No, it's not. And again, if you sell it, you've got to buy somewhere else. So they'll get to a point where the whole system freezes up, and the wheels just fall off, and it goes into free fall. It doesn't matter what anyone else says. It doesn't matter if I say it. The Bank of England say it. Nobody can really, truly, hand on heart, say what's going to happen in the future. And that's our job as traders, investors, speculators, to pick trends, to get on the back of them, and to trade different products, to invest in different things, to have that diversified risk. And, again, if we're all just tied up into the same thing and putting all our money, on house prices, then what's going to happen when they start going down? Because invariably, they will at some point. So we're kind of consolidating towards the top of the range in the euro dollar, so I still think opportunities to be selling high and waiting for this break back into this big candle. The strength coming into the pound again, I think is going to continue when we hold above these levels towards the top. I know it's 1.618, and gold just waiting for that top, really, because I still think, my opinions on gold have very rarely changed over the last few years, that every time we hit, a significant high, it's a good place to sell. So, we've come from a really kind of overbought territory, and we're still kind of climbing. So for me, realistically, we're just going to wait for that momentum to run out, probably not towards the top of the ball and overextension. So 1240 spot 70 for me would be an absolute great selling gold. And FTSE, I'd be amazed if the FTSE doesn't hit 7,000 this year. With the S&P, making highs, and getting above 2,000, the Dow, the DAX, everything else. I'd be amazed if the FTSE is the only major market not to hit that technical and fundamental type level. I would just be amazed. So 500 points off. I know it's, not going to happen today, but I would suspect before Christmas we see one final push higher before we then start seeing mid part of next year, probably Q2, a serious correction on the stocks where people start to pull the money, pull the profit out long term. I'm not talking about retail, because no one cares about retail. I'm talking about institutional type money, proper big investors. There's so much money in stocks all over the world, in the S&P, the DAX, and the FTSE, that when we do start to liquidate these monumentally large positions, we're going to see some massive shifts in the markets. And it's just it's just inevitable, isn't it? These things are just inevitable. I mean, the reason why markets are so high at the minute is because capital is not got a better or more efficient place to put it. The companies are making it very, very clear that they're going to pay the best dividends and they're going to, pay the most back to shareholders to keep that money pouring in to the balance sheets and to keep it pouring in from investors. But they get to a point where, Google, Amazon, Apple have more money than countries. More money than countries. And then people like Google and Amazon are dodging some of the biggest tax bills ever. You can't have it all your own way, world. We can't have everybody making money in their investments, everybody making money in their houses, companies making record profits and not paying taxes. It can't carry on, can it? These things don't make a balanced society and economy, and something has to give. So when the stock markets finally do decide they want to correct, it's going to be fast, it's going to be hard, it's going to be brutal, but it's natural. It's not a bad thing. Because, the stock market's going down is not a bad thing because that's people liquidating and taking the profit. So stock markets going from record highs and correcting isn't bad news. It's good because that money we pulled out and probably put somewhere better. Okay, maybe put back into investment or put back into other avenues. So, stock market's going down. It's not the big fear thing. If we do see a crash in the stock markets, somebody's made a boatload of money. So, again, it's all fear and boring media hype. And that's what you have to cut through as a trader and understand the underlying tone of what things are happening. And stock market crashes and corrections are just something that happens quickly rather than over a period of time. So when markets go up, we don't say, "Oh no, there's been a stock market boom in a day. We're all doomed." But stock market's going up, over exaggerated moves in one day, in 1 week, in 1 month are just as damaging and dangerous as them going down because it's not real money, is it? It's only real money when people liquidate it and get it out and they've made that profit. Until then, it's just, on your balance sheet or on your portfolio that you're long stocks or you're long indices. Always about looking at the bigger picture. Right, we've got 8 minutes before the Bank of England, again, comes out and says if it's going to change interest rates or not. I mean, the whole market's going for not change, which is fine. But it doesn't mean the markets won't move. If it comes out unchanged, then there will be some movement in the market. There might be some profit taking. There might be some liquidation. You just don't know. I mean, the FTSE's breaking these lower levels now. So the FTSE's, either severely, taking some profit or, again, it's, I don't know. It's not the end of the uptrend, that's for sure. But we're certainly squeezing all the bulls that have been short term in the market, in these big buying candles. So we're feeling a lot of pain now. Anyone that was long from yesterday is getting out now. So the market could easily push down to these lower levels before we see a bounce back up. So continued down movement. Gold really holding towards the highs. Again, the more the indices come off, the more likely gold is to hit these highs. But I suspect that we have a quick, sharp sell-off in the next candle. The market finds some sort of support, bounces up, and then gold hits these highs and then comes down. So, again, the inverse correlation between gold and indices is coming back to a certain extent, but I don't think the indices selling off is going to push gold back to 1400. Any other products you want to go through, guys? Got 7 minutes before the Bank of England. Has anybody got any thoughts on anything else from a technical perspective? Dollar yen. Okay. Well, dollar yen, yeah, getting higher. I think I was on FX Street speaking to Dale Winton or whatever his name is. Yeah, I said we're going to get back to 110, and we have. So there we go. Markets again have hit the lows, consolidated, beautiful pennant here on the monthly. When you're trading stuff like the dollar yen, it does trade very, very technically. So you see this nice monthly consolidation pennant, and then we break to the high side, support, resistance comes support, market then again consolidates, going higher. So I'd expect really to see along this trend line somewhere that when we hit the lows, back to 107 spot 394. The market then breaks these highs, and yeah, we could easily get to 121 within the next kind of 6 months easily. Again, this downtrend has been confirmed now that it's over, and we're above the guarantee. I'll just show you in a blank chart. Then we started here, got to the lows here. Where's your 50% here? That's where the market turned at 99 spot 714. Market then is going to go again, find support on the 61.8 if it comes back down. And as long as we do find support above 105 spot 282, then these highs are certainly going to be hit. Let's do it from another perspective. Low to the high. No, that's not the ones, is it? Yeah, sorry. So if you do break higher than that, then your next fib level is 153. That'd be all-time highs, I guess. But the scenario's here, isn't it? We're holding above the 50%, hold above the 61.8 here, break target of the highs here at 123. So potentially, what I'm saying is, if I think the market's going to get here, so you've got 1,300 ticks to make for your. No. So put your stop down here. So 1,000 tick stop. No, that's not going to work, is it? Yeah. Don't know actually. It's not quite as clear cut as I thought. There's a bit of a theme today, doesn't it? So maybe your dailies are a bit better. Yeah. Kind of seeing some consolidation here, and we're selling off, but I pay attention to this level really. Around about 107,584. If the market closes above that, we've got every chance of consolidating within this bullish movement here, and then going back up. But if we start to close below it, then certainly we could look to get back to 105. Yeah, difficult that one actually. Not quite as clear cut as I thought by any stretch of the imagination. I've kind of my thoughts were all once we broke these kind of highs here. Then at 93, we're going to get to 100 and then 110 above that. So that's kind of been done. So my views on the dollar yen are kind of all been priced in now. So I'd have to think about a new approach and a new kind of strategy. It's what I thought happened, and I don't know. I don't know if I'm a buyer or a seller right now. It still looks a lot more bullish than bearish. And again, the dollar being the world's currency, and the worries and fears over the Chinese and Japanese and emerging economies would push that dollar higher. But I don't think it's a good buying opportunity or selling opportunity for the long-term picture just yet. So on the hourlies, you see what the chart's saying. Yeah, nice correction. We've hit the highs, pivot on the 50% and come back down. So really, this level at 107,394, is a good one. So if we break this low here and don't get much lower, then I'd say that's a good buying opportunity. So watch for 107, 107 spot 41. If we kind of I'm fairly sure we're going to break it, but if we don't kind of make it a concerted effort to get to 105 and we just hold and consolidate, I'd certainly look for buying opportunities because the overall trend is up. So watch that level there, and I'll be buying into any rejected weakness. Okay. What do you think, Mashu? Well, no, I mean that's the whole point, Ray. What I'm saying, I wouldn't sell in the short term because what I'd expect is to see a quick down move to break. So maybe 20 ticks, 50 ticks to break, and then the market recovers. And perhaps gets up to here. So I wouldn't want to sell to make 20, 30 ticks. What I'd like to do is to buy any weakness that's rejected and buy back into the range. Yeah, 1 minute to go. Well pointed out there. Again, we don't see any particular shock announcement, but let's just keep an eye on this FTSE to see if there's any good. 10 seconds for this announcement, guys. Unchanged. Okay, unchanged. So maybe one final push down in the FTSE. Again, you always get no statement. Okay, so no statement from the Bank of England, unchanged in rates, so nothing out the ordinary. But we've seen a big sell-off prior to this in the FTSE. So let's just see. A lot of people who are buying and say, well, this can't go any lower. And when it does, make these kind of, quick moves up, you generally see the push up, then reverse and get back to the low of the previous candle and go down. So we've got, quite some way to go. But I don't know. I can see that the longer we hesitate around the bottom, that we're going to get to this low, re-break it, and test lower. So 6,470.97 would be a logical support resistance point, and then below that, obviously, we've got the lows down here at 6,458. Gold's just holding towards the highs, not really doing anything, and we've really kind of stalled towards the high in both the euro dollar and the pound dollar in cable. Let's just look at this on a 15-minute chart. So again, there we go. So if it breaks this low, don't be surprised if we don't, see a very, very quick breakdown to these lower levels, because we're outside the Bollinger Bands now. So yeah, there we go. So 6,470.97 could be an interesting one. Then maybe again, if we break that, probably buy back. At the start of the FTSE, the start of the fib up down here. So we're going to get a bounce back at some point. It's just natural. It's just the way trading is. But what we're going to find is everyone that kind of like has seen all these red candles and just buys here. It's just like, yeah, of course it's going to go back up. We'll get all the buys in, and then the institutional will smash it back down very, very quickly through everyone's 1% stop, and then we'll just buy it back. In probably one candle, we'll get back to 6,505. So a bit of indecision in this 15-minute candle here. So you can go down the time frames, guys. Look at the 5 minutes. So indecision, not really anything of interest. There's no statement for the Bank of England. There's no change. So it is a non-event. I can't really make it any more exciting than that. Okay, John is just saying he's short the FTSE. So stop close at 6,472, profit target 64. Yeah, looks good to me, John. Yeah, I mean, again, the FTSE, the 50% fib has worked absolutely beautifully once again. Once we've come back down to lower fibs and retested the 50% and been rejected, then your 100% retracement of this move here. Beautiful, beautiful support resistance. Then it's down from there on in, isn't it? Well, sorry guys, yeah, a bit of a non-event, I'm afraid. As always, the money's to be made. In my talk 6 months ago, it gets a bit frustrating sometimes. I say these great ideas, and I was saying, the interest rate's going to go up. Start buying, the pound against the dollar, down here. And this is what the institutions have done. All the markets are selling off now because we all know interest rates are going to go up. The institutions are buying back down here, yeah, and buying here, yeah, knowing it's going to get back up, and then taking the profit when all the retail traders have caught onto the game. But I don't know, difficult one, isn't it? Still, I'm still going to be buying, any major lows in the FTSE. I still think it's going to get to 7,000 before the end of the year, and I don't think the major correction is going to come till probably this time or a little bit earlier next year, because there's still so much money and greed tied up in the markets that any major low is going to be bought back up. So I still foresee that for the short term and medium term, the safety of funds lies in stocks. Where would you put your money? In Greek debt or Google shares? Yeah, easy one to answer that, isn't it? So I still think there's a lot of money and a lot of room for the market still to push up, and I don't think we're going to get in the FTSE to 7,500, 8,000 or anything like that. But I think we've got every chance of getting to 7,000, 7,200 before we then consolidate, and then the markets in general, the S&P, the DAX, all consolidate, and then have this big sharp correction. So a bit of a non-event, I'm afraid, guys. Gold again. Look for it to sell at 1240 spot 70. The FTSE. Again, as John said, 64. Yeah, it was a good target for me. I would expect one final push down, because when you see these kind of formations, you retail traders will say, well, it has to go up at some point. So maybe we see one final big red candle, or even one big candle that's just a big wick and then indecision, and then the market goes up. Look back in time through the charts, try and predict what happened in the past to what could happen in the future. We hit the lows here. What happens? One final attempt to break down. Yeah, market then closes, market opens, goes down, and then goes up. So look how the previous big sell-offs act. Yeah, one final, yeah, closes towards the bottom, but then comes back down, breaks them lows, gets all the longs out, then goes up. So again, look what happened previously in the charts. Try and predict. Bollinger Band, bottom, break, close inside, then goes up. So what are we in relation to the Bollinger Bands now? Bollinger Bands here, so we might see one final breakdown to here, or maybe here, outside the Bollinger Bands, then close inside the Bollinger Bands and get back to the midpoint. So you got loads of opportunity here. Maybe you stop if you're getting long down here is here. So 128 ticks to make 500 ticks. That's what I'd be doing. I'd be buying areas around here and here, looking for the market to get back to here. The trend is still up. Yeah, monthly chart. Trend is still massively up. So, it's not the end of the world just yet. All right, guys. Well, not really much else to talk about, I'm afraid. It does happen around these live events. We can't always make them exciting, but it's always worth, looking at the charts around this data and understanding where the markets have been and where they can go. Fundamental data is the key part of trading, guys. It's 20%. Absolutely 20% of your trading is down to fundamental movement. So tie it in with your technicals and you've got a stronger standpoint. It's the opening part of my book, guys. And I can't tell you what a pain in the arse it has been to write this book. It has been a nightmare. Editing process, when you're not a writer, is one of the most frustrating things you'll ever do. So when this does get published, and I'll make sure it's published if it kills me, there is a lot of key thinking and key thoughts. It's become a manual. It's become a guide, a Bible to trading now. It's just I can't tell you guys. I can't stress how much work it's been. But when you do start to read it and understand this, all the things I talk about in the webinars is understanding the mentality of the institutional versus retail. It's understanding the pain points. It's understanding that when you see a chart like this, your instinct is to buy, but in the reality, the instinct is to buy later. Yeah, wait for the confirmation. Yeah, it's all great. Indicators telling you to buy, but you have to buy at the right point, and the right point is not here where retail traders will buy. It's here where the institutional traders will push it to buy back and get all the retail traders out, get them all to doubt themselves, and then when you would have bought anyway, the market then goes up. Okay, so look for these levels 6, 4, 70 to 9, 7, and then just the start point of where this this move started. So again, it pains me, to be right all the time, and maybe I should just give up these webinars and just go back to full-time trading. But while I'm not, and while I still enjoy doing the trading, guys, I'll still keep turning up and giving you the benefit of my experience. But realistically, this will be the point to buy 6, 4, 70, but may not the first time around. Maybe the second time around. Let it break down, let the institutional do what they want, and then buy it back. Yeah, who knows? Listen, guys, what title have I given it, John? Well, it's called the RUFF Guide to Trading. Could it really been called anything else? There we go. All right, guys. Well, listen, plenty more stuff coming from me on FX Street. Bank of England. I'm going to stick with the Bank of England because when it does come, I've been saying it for long enough. I need to be there when it says Bank of England raise rates. I need to be doing that webinar because 4 years on FX Street and a year predicting it, I will be there when it does happen because it is going to happen. All right, guys. Well, listen, have a good afternoon. Take a screen print if you want. There's some good technical levels on here. Again, these things you need to look out for. So, your levels, resistance, come support will be down here in the pound. So 1618. Against the dollar. Euro selling any highs, so look for a break of 127485. Gold, again, if it gets 124.70, sell it. And FTSE 6470 is a good buy, but probably on the second time around. So maybe wait for a quick break down here. Levels markets kind of hover around 6458 and then buy for the way back up. All right, guys. So just press print screen, put it into a Word document or whatever. I'll probably post it on my Twitter feed anyway, so you can have a look. But again, look for that past prediction. What happened in the past, will happen in the future. All right, guys. Have a great afternoon, and I'll speak to you all soon.